Welcome to our High Rock monthly video for November. We are presenting a little later than usual this time of the month because we wanted to see how the U.S. election results played out in financial markets. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, and we are approaching our 10-year anniversary. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. And we have recently updated our website, so hope you have a scroll through just to see how that looks. It shouldn't be much different, actually, but
see if we made any mistakes.
Yeah, that's a good idea. and then feedback is always appreciated. October was an eerily quiet month for financial markets as we waited for the November U.S. election. Really, it was the peak for gold and silver, which usually happens, Paul, right? Because of uncertainties. Usually, it's considered a risk or a risk off kind of asset to own. But for the most part, equity markets were, and bond markets for that part, were little changed, although we did see some selling off of Canadian REITs that had done better in the summer, or more in October and September. But they're back now to being close to flat on the year after a bit of sell-off during October.
Yeah, and REITs are extremely interest rate sensitive. So as the banks started cutting rates and the Fed followed suit, they started doing a bit better. But we can talk a little more in our model updates about what's been going on with rates in the month of November, especially.
Perfect. Thanks. And it was equally quiet for our balance mandates. Little change from September. As we compare our portfolio returns to the Morningstar averages of over 1,000 balanced funds. Most of will find that over the volatile 3-year period since 2008, the most volatile period 3-year period since 2008, High Rock balance mandates have basically outperformed because we were able to mitigate the downside in 2022. But as always the case, if you wish to discuss your particular portfolio in detail, please reach out to us. Paul, do you want to send any updates on the special mandates?
Yeah, there really isn't a lot, and we can touch on this in the fixed income model as well. But within prefs, I think we mentioned last call that the BMO.PR.W has been called. That sits in everybody's portfolio, both the balance mandate clients and the pref mandate clients. It will be redeemed or called. They call it redemption in the pref market. But the issuer, Bank of Montreal, is redeeming that pref. So that will turn into cash. Basically the day after, November 25th is the redemption date. We still hold, so that will go up some cash there, and for pref clients, that's a pretty good size weight. And we still own the commerce.pr.p as in Peter, and that one is due to be either redeemed or extended on January 31st. So they have to give minimum 30 days notice. So I suspect sometime before the Christmas break, this typically has been happening 45 days before. So I would imagine in about another month, we'll hear on that one. So again, both for the pref mandates, they have a good size weight in that, and our balance mandates have a good size weight in that. We will go up cash in both. And the balance mandate, Scott, our typical client has, probably 5 to 7% weight between those two prefs that we will go up cash.
But they've been overweight in those prefs for some time. So this is just a moving back to slightly at weight, or is it slightly underweight?
Yeah, I think it'll well, no, it'll put us back, once both are redeemed, that'll put us back to our at-weight target for the pref model, and the pref portion within the fixed income model and our balance mandates. So
Well, that's
that's,
excellent. And to a degree, the performance of those preferred shares have added value to all our clients' balance mandates. So well done, Paul, on that that
well,
play in
yeah,
the in finding value. I had a meeting with clients today, and I was explaining that we don't just put all your assets into an allocation model that's balanced and just leave them there. We are constantly rebalancing and looking for opportunities that, like this preferred share opportunity that Paul was able to take advantage of, and that is how we add value, and a lot of it, behind the scenes.
and I'll
And
just, sorry, Scott, I'll just
oh,
touch on high yield.
yeah,
Really
sorry.
nothing to, there's really nothing to add other than to say, it was a pretty flat-ish month. As you mentioned, October was kind of quiet waiting on the election. So that's that.
Okay, and as everyone is aware, our major focus is on your long-term goals, and hopefully some of the things that we do in the short term are to help make your long-term goals, reach your long-term goals, and get them closer. But it's always important that we have these conversations about your goals, and just to retouch on your strategy so that we know that the strategy that we're putting in place for you, the asset allocations are right for your long-term goals. So we're here. Please reach out if you want to update. Quickly on the global equity strategy, let's talk a little bit about what's going on right now post US election. Certainly, it's been favorable for US equity market prices, and the opposite for international equity market prices, which have gone down. So since the election, we've seen a 4 to 5% increase in U.S. equities, and a 2 to 3% decline in international equities. So it is the market pricing in expectations for the next 4 years of Republican control of the White House, the Senate, Congress, and with that, those expectations are for higher U.S. import prices, lower corporate taxes, and all of that being somewhat more inflationary. And Paul, let you talk about inflation if you wish.
Yeah, we were, as you said, Scott, meeting with a client this morning for a little bit, and some concern about inflation. I think the one thing to recognize is that whatever the new U.S. administration does, the Trump administration on the tariff front, should really be, it's going to take some time to evolve. The markets will get ahead of that. But if there are big tariffs coming in, it clearly is a protect and improve America situation. But those will roll off. They're largely going to be, I think anyway, put through at once. So after 12 months, then inflation should come back down because the 13th month will roll off, like the final month of any inflation. Now, that's not to minimize the potential effect of inflation and the fact that the market already through the past week, if not a little bit longer, since it started sniffing out a Trump victory, is getting ahead of it. So, for instance, 5-year bonds in the U.S. are up, damn close to 50 basis points over the past 3 or 4 weeks alone. So, and the back end of the curve is, i.e., 10-year and 30-year are up more. So, probably even 2 months now, they're up by 100 basis points. That will hurt the U.S. economy as well. It hurts everything from car loans to mortgage applications, you name it. And whereas in Canada, we're going to be in a bit of a different situation, and the effect of those tariffs will likely hurt our economy a little bit, would be my view. And I think we need more we're going to need more rate cuts, more aggressive rate cuts. The bank meets, I think, Scott, is it December 11th, I believe?
Yes.
Yeah, okay. So I think they're going to go 50 again, and the consequence of that will be a weaker Canadian dollar still. So
And that should be interesting for our clients who spend the winter months south of the border. They can expect that, and we should have these conversations too. But if the Canadian dollar starts to get weaker, we do have assets in U.S. dollars. In most cases, it's somewhere in the vicinity of 20% of a client portfolio. In the balance mandate, would have about 20% in U.S. dollar denominated assets. So you do have U.S. dollar exposure, which is to your advantage and will help mitigate the potential of a weaker Canadian dollar going forward.
I actually just thinking out loud, I'll be brief, but one thing on the inflation front, the expectations of inflation, these tariffs clearly could add to US inflation, but the number one thing that creates and adds to inflation is government deficits. And if the Trump administration can figure out some fiscal austerity through all this, that could be a pretty powerful weapon at keeping inflation in check. So that will be key. And I really don't have a view. I mean, he doesn't seem like a fiscally conservative guy, but having said that, if anyone listened to some of his interviews, until they hit COVID, they were doing reasonably well. But we'll see. We'll see.
And just to finish up on the equity model, as always, we will continue to rebalance portfolios when equity prices get higher or get into what we call greed territory, and we'll rebalance back to buying cheaper assets. So what we see right now is U.S. equities are expensive, international equities are cheap. So we'll rebalance to selling more expensive assets and buying the cheaper underweight assets. Paul, tactical strategy.
Yeah, I'll just give a couple highlights. We'll start with there's the good and the bad. I don't know if there's any ugly. Well, the bad may be ugly. Our one position in BCE, Bell Canada stock. This is post post the month. This happened in early November, a week ago. They ended up, as people may or may not know, they sold their share in Maple Leaf Sports and Entertainment, and very quickly, I'm sure this was in the works, a year ago. They bought a fiber optic business in the U.S. Northwest coast for more than the proceeds of MLSE's sale. So they took, I'm quite disappointed in this because, part of the reason why we own BC stock was really a pretty stout dividend, but one that modeled up okay from a free cash flow perspective, i.e., the payout ratio was not exorbitant, and the stock was trading at pretty low valuations. This was a zero growth business. All they had to do was cut expenses, and there would be some pricing discipline coming back into the business with the three big, what are called ILECs, the incumbents, Rogers, TELUS, and Bell. All they had to do was cut expenses and just run the cash flow. I've seen this in other businesses. In fact, even in Yellow Media, which we own, they're melting, the businesses themselves are melting ice cubes. But they decided they needed growth, and that growth cost them 10% last Monday on the stock in one day because of this transaction they did. So big problem. We will not be adding to BC stock. I don't see any upside to it at all. I don't think any hedge funds are going to get involved. I don't think business doesn't have any growth. So there's nothing in it other than this dividend. And quite frankly, that dividend now is a little more suspect. They should have been paying down debt and cutting expenses. It was a pretty simple business model for a very mature business. So that's the bad and the ugly. The good, not so much in the month of October, but I can tell you, as of certainly today, in the past couple days here, our largest tactical position is in Source Energy, which is the sand fracking supplier. They reported late last week, and had their conference call, and these metrics continue to look better and better. There are only really two publishing analysts on the street that cover it. They're both low in their targets. They had to move them up. So even since the end of October, the stock is up around 20-25%. Which is around $15.25. I still think this thing will get taken out well north of 25. They did do a JV with a pressure pumper, Trican Well Services. I think they're the likely candidate to take them out. I don't know why they wouldn't consolidate the business. These guys have, I asked them on the conference call, they have 45-48% of market share in the Western Canadian Sedimentary Basin. So, and we are still, I've mentioned it before in calls, we are still waiting, which I think we should hear tomorrow or Friday, on a refinance of their credit facility and their bond, which our high yield investors still own. As you recall, we sold the bond in the balance mandates and bought the stock last summer. So that's where we sit with those. And that really is, those are the two sort of highlights within tactical, Scott.
And fixed income, obviously, we talked about bond yields, but
we did. I think the only other thing to add about bond yields is, given the bank is easing here in an easing program, and these things typically go on longer than you think, just like they do in a rate hike cycle, a rate cut cycle goes on longer than you think. So the shorter end of the curve, when we say shorter end of the yield curve, we're referring to sort of 5-year and under, should hold okay. The back end of the curve is a little more of a question mark, but we own a lot of the corporate bonds we own are very short in nature. You know, some of them are 1, 2, 3 years. Like we don't really own anything out beyond 5 years in the corporate world. So even though those bonds are, some of them may be marked below par being $100, they'll pull to par every single day. So that's pretty important. So if you own a 1.5-year bond, every day you pick up a couple pennies as you pull to par. So that's something to keep in mind. And that really is what's called the duration of our portfolio. So we have a reasonably short duration in the portfolio. Just going around this pie chart, then we've talked about government bonds. I've already talked about preferred shares. So we're going to go up some cash, hopefully in the next month, both from the BMO and the Commerce Prefs. Investment grade bonds, they have very high correlation interest rates. So they have given up a little bit of ground here over the last while, but again, they're very short duration, and same with high yield bonds. They've given up less ground, but they are also very short in duration. That's it.
Yeah, and just to say that when you say pull to par, that just means that when these bonds mature, they will mature at their original issue price. So when bond prices fall, inevitably they will come back to their original issue price as they get closer to the maturity date.
Yeah, and in some cases, as I said, it could be a year, it could be 2 years. You know, if you're talking
Yeah.
about 30 years, well, it's a long time to wait. But you know, most of these bonds that you see in the pie chart are, you know, under 5 years.
Excellent. Thanks for that update. And that's it. As always, we want to thank you for taking time out of your busy schedules to tune in. We'll be back with our next update at the beginning of December. And hopefully I'll be in Mexico next week to watch Miranda Tomlinson compete in her last event of the season at the Ironman Cozumel. But there is a hurricane headed that way, or a tropical storm right now, but there may be a hurricane, so I may be sitting in my at my desk next week. We'll see what happens. Anyway,
Good luck.
yeah, thanks.
And good luck to Miranda.
Yeah, thank you. If it happens, it'll be, unfortunately, it would be the second time that a hurricane has, we'll say, blown her off course from a race. So we'll hope to keep our fingers crossed. Anyway, until next month, this is Scott Tomlinson on behalf of Paul and Diane, and bidding you a great rest of the month of November.